Hello class.
I'm going to go
at this time I'm
over
going to
a
review
couple of
another
exercises
exercise in
with you
Chapter
today.
5.
From
Chapter 5
Chapter 5 deals with
analysis.
topics of
This
pricing
exercise
decisions
is
and profit
5.8.
analysis.
So we're going to do
That's located on page 153
exercises 5, 7,
of our,
and 5, 8.
healthcare
5,
fundamentals
7
of
is
healthcare
on pages
finance,
152 and
textbook.
153.
On page
Exercise 5, 8 is on
153,
page
it says you're
153.
considering starting a walk-in
In
clinic.
exercise 5,
And your financial projections for the
7,
first year of operations
we're dealing
are
with
as
General
follows.
Hospital,
so
which
revenues,
is a not-for-profit acute
based
care
on
facility.
10,000 visits,
and then
you have
provided
other
with the
expenses,
cost,
both variable and fixed
and
expenses.
revenue per inpatient
Assume that all
day.
costs are fixed,
So we have fixed
except
cost of
supply
$10 million,
costs, which are variable.
and
Furthermore,
a
assume that the
a
clinic
variable
must pay
cost
taxes
per
at the
inpatient
30%
day
rate.
of $200.
And then
So
a
the
charge
first thing that we're going to do is calculate
revenue
a
per inpatient day.
profit and loss
And
statement.
it's expected that the hospital
Revenues
will have a
always
patient load
head
of
the P&L
15,000 patient days
at the top,
inpatient
and
days
that
for
would
the
be the
next
$40
year.
per
So
unit.
the first question asks to construct the base
10,000
case
visits, projected P&L
we
statement.
know that
That's the
because
profit and loss
it's
statement.
400,000
So
in
this
revenue.
area that I'm highlighting
and
right
10,000
here,
visits. There's
to calculate that, you're going to multiply the revenues
for our variable expenses, the only
15,000
units or
supplies,
inpatient days,
which would be a medical and
times
administrative supplies for a total
$1,000
of $6
per
unit,
inpatient day,
or
that equals $15 million
$60,000 total.
60,000.
We're going to subtract the variable cost
per unit. That's the $200
The remaining cost,
variable cost per
will
inpatient
be
day
fixed
times the 15,000
That adds up
units,
to
and that's
$203 million.
$57,500.
And then we calculate the contribution margin.
Cost of
As you may recall, the contribution margin is
for
the
your
difference
variable and fixed
between
cost.
revenues and variable
We'll
costs.
then take our total cost.
We'll then subtract our
and
fixed
subtract
cost
that from
of
the
$10 million,
revenues of $400,000,
and
and
12
that will
million
give us,
minus 10 million
taxable income
equals
of
a profit of $2 million.
$82,500.
For
Multiply
question
that times
B,
the total
what is the
tax-
hospital's
taxes
break-even
of
point?
30%.
Well, to
That
calculate
equals
break-even,
$24,750.
you will take the
If we
subtract
subtract
that
that
number
number
from the
of $10 million,
$82,500,
your
and you'll
total
divide
profit will
that
be
into the contribution margin per
$57,750.
unit.
And
the
that's the
contribution
answer to
margin
part
per
A.
unit is what we did above here.
In part
And
B,
that's $800.
we're dealing with
1,000 minus
break-even,
200.
and we have total
Therefore, to
fixed
break
cost
even,
of $257,500.
the hospital needs to have at least, or
we'll
have a
divide
patient
that
load
into
of
our variable cost per
12,500
unit.
patient days.
That's
They
going to be
currently,
the
or according
40
to the
P&L
here,
have
minus the
15,000.
6 for a total of $34 per unit.
In C,
And if we put that in our
what volume is
denominator,
required to provide
that
a
will give us
profit
a
of $1 million
break-even
and
volume
a profit of
$7,574
visits?
What we call that is
In
the
part
target
C, we're
profit
dealing with
analysis.
target profit.
So if we do the 1 million,
$100,000,
that will give us a total value in the
profit.
numerator of $11 million.
So
therefore, we have to calculate divide that into the contribution margin.
The 100,000
of
into 1
contribution
minus
margin
the
per
tax
unit of
rate,
800,
or 100,000
and
divided by
with
0.7.
that additional
or
profit of $1 million, we'll have
142,857.
to earn or have to get 13,000. If we add the total contribution margin,
if we do
to
the
our fixed cost,
additional 500,000,
that will give us
10
$10,500,000 divided by
800,000 for a total of 13,125
We divide that into our in D.
It says now assume that 20% of the hospital's inpatient days come from a managed care plan that requests a 25% discount from
So
charges.
we have to calculate again
Should the hospital
the
agree
after
with the
tax,
with the discount proposal?
pardon me, the pre-tax.
So we're still going to have the
profit
same
here,
revenue per
not
unit,
the
variable
after-tax
cost per unit, and
profit.
contribution margin per
and that will
unit.
give us the number of visits.
If we have
And
a
that concludes our
reduction in
overview
inpatient
of
days of
5.8.
20%,
Thank you very much
now
for your
we're
time
down
and attention.
to 12,000 inpatient days. So that will adjust our revenue, variable cost, and contribution margin. It will now become $9,600,000 for a contribution margin. Remember, our fixed costs do not change regardless of the level of inpatient days. So now we will suffer a loss of $400,000 due to the decrease of 3,000 patient days. That's the 20% decrease. So therefore, the net income or net loss is now $400,000. So the contribution margin, in effect, does not cover the fixed cost. If they accept the discounted revenues, that will have a positive impact because that will increase the revenues even though it goes from $1,000 to $950 per unit on average, we have 15,000 inpatient days total. Our variable cost will come to $3 million, and therefore our contribution margin will be recalculated at $11,250,000 minus the 10 million in fixed cost will give us a profit of $1,250,000. So that would be an advantage with the discounted revenues. And that concludes the review of this problem. So if you have any questions, feel free to let me know. Thank you very much for your attention.